Hello, my name is Magnus Petersen. This video shows how to properly measure whether a share buyback causes a gain or loss for the remaining shareholders, and this depends on the company's future earnings, dividends and share prices, which are all uncertain, so we will also use a new simulation system to give a complete overview of the possible outcomes and their probabilities. Let me first give a brief introduction so you understand the importance of share buybacks and the common beliefs about them and why those are wrong. In the United States, the majority of corporate earnings are now spent on share buybacks instead of dividends. Last year, over $1 trillion was spent on share buybacks, and one of the main reasons this is being done is because academia believes that share buybacks are generally better than dividends, but the arguments are moronic pseudoscience because they are based on assumptions that do not hold in reality. Later in this video, we will see that half of the share buybacks of the last 30 years have actually resulted in losses for the remaining shareholders. So this is an extremely important topic for society in general. Finance professors used to say that share buybacks were a signal that management had inside information that the stock was undervalued. But there were countless examples of companies that made share buybacks at peak share prices, after which the share price started to decline, and sometimes the company even went bankrupt. So that theory was clearly not correct. Now it is commonly believed, both by finance professors and by CFOs and stock analysts, that share buybacks and dividends are equivalent ways of returning capital to shareholders, but there is a tax advantage for the buybacks. The proof of this assumes that either the share price perfectly equals the intrinsic value to long-term shareholders, or that the valuation ratio, such as the PE or price-to-book ratio, remains constant in the future. This is obviously not true in reality, but finance professors then utter the phrase "all else being equal" as if it is some kind of a magic incantation that can turn absurd claims into solid science. In reality, a share buyback is a kind of investment the company is making in itself on behalf of the remaining shareholders. Whether this causes a gain or loss for the remaining shareholders depends on the share price relative to the intrinsic value of the share, that is, the present value of the future dividends and share prices. To intuitively understand this, consider that you buy a stock for $100 and it then drops to $50, then you have lost half of your money. It is of course similar when the company buys back its own stock. But for some bizarre reason, finance professors think that if a company buys back its stock, it hasn't lost half its money. In this video, we will first derive all of the valuation formulas. Most of this math is quite simple, and I would say it is actually just high school level math. And because the future is uncertain, we will also use a new simulation system on the simsim.run website, so we can get a complete overview of the possible outcomes when making a share buyback. The first part of this video is based on my new paper from the year 2026, which has many important extensions to my original treatise on share buybacks from 14 years ago. If you have more questions after this video, then I would suggest you download the paper from the link below the video and then upload it to an AI chatbot and put it in thinking mode, and it should be able to give you pretty good answers. So let us now look at the basic valuation formulas for a share buyback. And it is based on two so-called axioms, which is an obvious and undeniable truth about something. And the first one is that a share buyback reduces the amount of cash that the company has, and this is a cost. And the second is that a share buyback also reduces the number of shares outstanding, and this is a benefit. And the question is whether this benefit outweighs the cost. And in order to study this mathematically, we first define the so-called intrinsic value of the company, and we denote the total intrinsic value as lowercase v, and the simplest definition is to consider it to be the excess cash that the company could use for a dividend payout or a share buyback now, without hurting the future of the company, plus the future earnings for all eternity, discounted back to the present value. And we then use the capital V to denote the intrinsic value after the dividend tax and per share. So we want to know how a share buyback transforms this per share intrinsic value. And we use the two axioms from before. So first we subtract the buyback amount from the total intrinsic value. And then we have to calculate the number of shares after the buyback, which is the number of shares before the buyback minus the buyback amount divided by the share price at the time of the buyback. And this can also be reduced to this formula over here. And if there is a so-called excise tax on the share buyback, which they have in the United States now, then the formula becomes like this. And when we combine the decrease in the total intrinsic value with the decrease in the number of shares, we get this formula down here, which we denote W. So W is intrinsic value with the share buyback, and V is the value without the share buyback. We can define the intrinsic value differently, and it will lead to the same valuation formulas if the share buyback just follows the same two rules, that it decreases the total intrinsic value and the number of shares. But in a moment we will see a case where the formulas are slightly different, because we will also consider share price changes, but the ideas are basically the same. So the so-called equilibrium is where the share buyback does not change the per share intrinsic value. We write that as an inequality, W is greater than V, whenever the market cap, which is the total value of all the shares before the share buyback, is less than the total intrinsic value, which is adjusted for the excise tax on the buybacks. Now consider the relative value of the share buyback. So we take the per share intrinsic value with the buyback divided by the per share intrinsic value without the buyback. And we can reduce it to this formula here. And the overall numerator, so this part up here, I cannot select it in blue because it looks all weird. So I will just point to it with the mouse cursor here. So this overall numerator is basically the fraction of the intrinsic value that remains after the buyback. And the overall denominator, so this part down here, is basically the fraction of the market cap that remains after the buyback. And the overall relative value is the fraction between these two, and I will show you an example in a moment that makes this more clear. But note that both the shares and the dividend tax rate cancels out. These are irrelevant if we are considering the value to an eternal shareholder who will never sell their shares. So in my original treatise, I only had the relative value, and the problem with that is that the equilibrium where there is no effect from the share buyback has a value of 1. So in my new work here, I thought it was better to subtract 1 so that the neutral value is at 0. I call this for the return on intrinsic value, or the ROIV ratio. I have also made another valuation ratio, which is called the return on buyback, or ROB for short. And instead of dividing the intrinsic value with and without the share buyback, now we subtract them. And then we divide that with the buyback amount, which has been adjusted for the number of shares before the share buyback, and the dividend tax rate. And that is because the numerator in this ratio is also on a per share and after dividend tax basis. So the numerator and the denominator is a fair comparison. So this ratio has a few advantages over the ROIV ratio. The first one is that it is mathematically stable because it doesn't divide with the intrinsic value V, it only subtracts it. So this ratio can also be calculated when the intrinsic value is 0 or negative. But it is also very useful because it measures the gain or loss from the share buyback relative to the buyback amount. So this can be compared to other investments that the company can make by using the net present value ratio of those alternative investments, and we will see an example of this further below. So let's look at a few visual examples, and hopefully these will make it more intuitive what the formulas are actually calculating. So imagine that up here we have the market cap, that is the value of all of the company's shares before the share buyback. It is measured by this long light gray bar here. And below we have the intrinsic value, which is actually a bit less than the market cap. So this means the stocks are a little bit overvalued or overpriced in the market. Now let's say we are going to buy back 20% of the shares. So it corresponds to this dark gray box here. And we are removing the same box from the intrinsic value. So after the share buyback, the market cap is only this gray box here. And the intrinsic value is this gray box here. In this example, it's not so easy to tell the difference because the mispricing was only 5%, but after the share buyback, the mispricing is actually 6.25%. And if we take this value here and divide it by this value here, take -1, we get the ROIV ratio, which shows that the per share intrinsic value has lost about -1.3%. And we could also do the same with the ROB ratio. Let's look at another visual example where the mispricing is much greater. So the market value of all the company shares is still this long gray box here, but now the intrinsic value is actually only a quarter of the market cap. We are still buying back 20% of the shares, but that now corresponds to 80% of the intrinsic value. So after the share buyback, the market cap is this long gray box here, but now the intrinsic value is this very short box here, which is now only 6.25% of the market cap. And if we divide this 6.25% with the 25% before the share buyback and we subtract 1, we get the ROIV ratio, which shows that the per share intrinsic value has lost -75%. And I have tried to write the paper so it is easy to understand if you will just invest a little bit of time and effort into it. So I have also made numerical examples where I go through and calculate all of the formulas. But I won't do that in this video here because it is quite simple. You just take all of your values and plug them into the formulas. Let us now also consider capital gains. In the original treatise, I had argued that share buyback should always be made for the sake of the remaining shareholders, which ultimately means that the valuation should only consider the so-called eternal shareholders who will never sell their shares, so there's no need to consider the change in share prices when valuing share buybacks. But one of the main arguments in favor of share buybacks over dividends is that a share buyback is claimed to be a more tax-efficient way of returning capital to shareholders. And the proof of this typically assumes that the valuation ratio remains constant in the future, but that is obviously not the case in the real world. So let us extend the valuation formulas to also include changes in share prices and different tax rates for capital gains and dividends. We use the same future market cap in year N for both scenarios without and with a share buyback. And a moment ago, I just showed you a visual example of how the market cap changes after a share buyback, but that was the immediate impact of the buyback, where both a share buyback and a dividend would cause an equivalent decrease in market cap. But we're now considering the long-term future in N equals 1, 2, 3, 4, for example, up to 10 years. And at that point, the market cap is no longer affected by a share buyback that we do today. Typically, we estimate the future market cap in year N as, for example, the earnings for year N multiplied by the price to earnings ratio in that year. Or, for example, the sales in year N multiplied by the price to sales ratio in that year. And we do that because it is usually much easier to forecast these two factors separately than forecasting the market cap directly or the share price directly. So using this forecasted market cap in year N, we can then forecast the future share price for year N in the two scenarios without and with a share buyback. So in the scenario without the share buyback, the future share price in year N is calculated from the future market cap in year N divided by the current number of shares outstanding without the share buyback today. And in the scenario with a share buyback today, the future share price in year N is now denoted with a superscript W, and it is the future market cap in year N divided by the current number of shares after the share buyback. And if we go back to a previous slide, that number of shares with the share buyback is defined using this formula here, or this formula here if we also have an excise tax on the buyback. So let's go back to the other slide again. And for both the scenario without and with the share buyback, we calculate first the capital gains, then the tax on the capital gains, and then the present value of the future share price in year N minus the capital gains tax. So we can now calculate the after-tax per share intrinsic value without the share buyback, and we denote that as the capital V and subscript N for the future year N. So this is a holding period from today until the future year end, and that is the excess cash that can either be used for a dividend payout or a share buyback today, plus the present value of future earnings that can be paid out as dividends until the future year end, and this is adjusted for the dividend tax rate and the number of shares without the share buyback, and the so-called terminal value is the present value of the future share price in year end without a share buyback. And for the scenario with the share buyback, we define the after-tax per share intrinsic value as W subscript N, and that is basically the same as before, except we subtract the buyback amount from the excess cash, and we divide by the number of shares with a share buyback, and then we add the present value of the future share price also with a share buyback. So the equilibrium is when the after-tax per share intrinsic value with a share buyback W is exactly equal to the after-tax per share intrinsic value without the share buyback, but we write this as an inequality so we can easily see when the share buyback causes a gain or a loss to the intrinsic shareholder value. And the condition is this, and this formula and the one below are the only two formulas in the entire paper that are somewhat difficult to derive because there are so many variables to keep track of and make sure you get everything right. And let's zoom out a little and then look at this formula. And if you multiply it with this factor down here, you essentially get the formula up here that has also been adjusted for the excise tax rate on the buybacks. So in order for the share buyback to cause a gain for the remaining shareholders, the market cap must essentially be less than the intrinsic value without the buyback and also adjusted for the excise tax rate on buybacks. In order to get such a clean formula, we make a simplifying assumption, and that is that the share price in both future scenarios with and without the buyback, they are both greater than the current share price today. If that was not the case and they were both lower, then it means that the tax rate for the capital gains should just be 0. But it is possible that the future share price with a buyback is greater than the share price today, and the future share price without a buyback is lower than the share price today, in which case this equilibrium formula would be much more complicated. But it's a fair assumption to make, so you can basically see that the condition for the share buyback to increase per share value, that the market cap must essentially be less than the intrinsic value. In practice, when we want to calculate the return ratios, we just calculate V using this formula here and W using this formula here, and then we plug those values into the return on intrinsic value formula here or the return on buyback formula here. So that's how we do it in practice. But it is also interesting to consider the formula for the relative value. So we take the per share intrinsic value with the share buyback divided by the per share intrinsic value without the share buyback. And it is this long formula here, and this is the only other formula in the entire paper that is somewhat difficult to derive. But if you ignore all of the taxes, you will see that it is basically the same as the relative value formula for the simpler case that we had a moment ago. The main numerator is basically what remains of the intrinsic value after the buyback, and the main denominator is basically the fraction of the market cap that remains after the buyback. But otherwise, it is essentially the same formula. Once again, I have made a detailed example on how to calculate this, but it is basically just to insert all of the values in the formulas and then calculate the results. So I won't do it in this video here because it gets rather tedious. But I would also recommend that you try and implement these formulas in a spreadsheet so you can easily change all of the input values so you can see how a share buyback affects the per share intrinsic value when you change the input assumptions. Now we want to value past share buybacks to see if they actually caused a gain or a loss to the remaining shareholders. The formulas for this are almost the same as in the past two sections, but there are minor differences, and we kind of do it in the reverse now. So instead of starting by defining the intrinsic value without a share buyback, and from that deriving the value with a share buyback and then compare the two, we now do the opposite. So we define the per share intrinsic value with the historical share buyback in the start period for a shareholder who owns the shares until the end period, as the present value of the dividends during that period plus the present value of the share price at the end. And as I'm looking at the formula now, I realize that this is for annual data points. If you have quarterly data points, then the present value should take that into account. But that's a small change. So now we have to calculate backwards. The actual share count at the end of the start period is denoted with a superscript W. And that is the number that we have in the data because that includes the share buyback during the start period. And from this, we want to calculate the share count as if there had not been a share buyback during the start period. If you have access to a very expensive database, then it might have the number of shares actually bought back during the start period. But I am using a discount database, which doesn't have the actual number of shares bought back during each period, so I have to estimate it. And the way I do this is by taking the original formula for calculating how a share buyback decreases the number of shares, and I invert that. So now we have the number of shares without the share buyback during the start period equals the number of shares with the share buyback during the start period, divided by all of this here, which is basically the fraction of the market cap that remains after the buyback during the start period. In the original formula, this denominator here is basically just multiplied over here instead. So let's go back and take a look. So here we have the original formula where the number of shares with the buyback equals all of this over here. And all I have done is to take this part over here and divide it on both sides and then change the notation a little to make it clear what is the number of shares before and after the buyback and that it is for the start period. And if we go back, we see that is essentially the formula that we have here. We could also consider estimating the number of shares without the buyback using the historical number of shares from the previous period, but the problem is that this conflates the dilution from stock options. So it is better to use this formula up here where we are estimating the number of shares without the buyback from the actual buyback amount. So this means that we can now estimate the intrinsic value per share without the share buyback and for a shareholder who owns the shares from the start period until the end period. And we do this by calculating backwards from the per share intrinsic value with the historical buyback. So this is W, which was defined as the present value of the subsequent dividends and the terminal share price using the actual historical data. Then we multiply it with the number of shares after the historical share buyback so that we get the total intrinsic value and not per share. And then we add the net buyback amount for the start period. And because I am using a discount database, this is combined into a net amount. So if it is positive, it is overall a share buyback. And if it is negative, then it is a share issuance. If you have access to a more detailed and more expensive database, then you could separate the share buybacks and the issuances. So now the numerator is the total intrinsic value based on the subsequent dividends and the terminal share price for the end period, plus the net buyback amount for the start period. And then we divide this with our estimated number of shares without the share buyback. And that's how we take the actual historical per share intrinsic value with the share buyback during the start period. And from that, we estimate the per share intrinsic value without the share buyback. And now that we have those two formulas, we can use them to derive the equilibrium. So the share buyback during the start period increases the per share intrinsic value whenever the market cap during the start period is less than the total intrinsic value during the start period. So this is basically the same as the equilibrium formula for the other cases that we studied before. And we can do the same for the relative value. So the per share value with a share buyback, this is using the actual historical data, W, divided by the per share intrinsic value without the share buyback, which is denoted V and which we have estimated from W. And this formula is basically the same as in the other cases, namely that the overall numerator is a fraction of the intrinsic value that remains after the buyback, and the overall denominator is a fraction of the market cap that remains after the buyback. And if the net buyback amount is negative, it means that it is a share issuance. The ratio for the return on intrinsic value is basically the same. But the ratio for the return on the buyback amount, this is slightly different because we are using the net buyback amount. So the sign of the ROB ratio should only be defined by the numerator, that is the difference in the per share intrinsic value, and not by the sign of the net buyback amount, so we take the absolute value of that. We didn't have any taxes in these formulas, but you can add them back if you want. The problem is that the tax rates may be different for different people. I have also made an example of how to use these formulas, and I won't go through the calculations here because it's basically just plugging the numbers into the formulas. But I want to show you this table here because it shows very clearly that depending on the holding period for the shareholder, a share buyback during a certain start period may cause either a gain or loss depending on the subsequent dividends and share prices. So in this example here, the share buyback was made at $100. The first year there was a dividend of $5 and the share price was $10 higher. So the share buyback in the start period caused a gain of 1.6% in the per share intrinsic value, and relative to the buyback amount it was 18%. But then in the second year, although there was a dividend there as well, the share price dropped to $50, which was half of what the company paid during the buyback. So now we see that the buyback in the start period caused a loss in the per share intrinsic value of minus 6.8% for the shareholders who held the shares and sold them in year 2. When compared to the amount used for the buyback, it was a loss of minus 42%. So that means that the shareholder who sold their shares in the second year would have been much better off with a dividend payout in the start period. Only in the fourth year will there be a gain again from the share buybacks during the start period. In a moment we will see plots of the ROIV and ROB ratios for real companies, and what they're showing is basically for every single start time, they calculate these ROIV and ROB ratios as we have done here for all possible subsequent periods. So this is for 1 year, 2 years, 3 years, all the way up to, for example, 20 years. And then it calculates the mean and the standard deviation of that, and it shows that in the plot. I have tried different ways of plotting this data, but the problem is that there are several dimensions to be plotted, and it's very confusing. So I found that plotting the mean and the standard deviation was the best way. So let us look at a few examples of historical data for share buybacks, and we go to the simsim.run website. We click on data, and let's type in RGR for a stock symbol, and then we get the data for the Sturm company, which is a firearms manufacturer. And we click on the returns tab and share buyback, and then we have 4 plots here. The top plot shows the price to sales ratio for the stock, and that is used to show overall whether the stock was cheap or expensive. The second plot shows the net share buyback amount relative to the total assets, and that is used to show how much the company was buying back or issuing stocks relative to its size. And comparing the 2 top plots, we can see whether the company had a tendency to buy back stock or issue stock when the stock was cheap or expensive. This is a very rare example of a company that only bought back stock when it thought it was cheap. For example, here in 2006, and here in 2007, and again in 2014 and 17, and a few other small buybacks here and there. The 2 bottom plots shows us the return ratios for the buybacks. So first we have the return on intrinsic value, which shows the gain or loss in the per share intrinsic value. And for example, in 2006, on average, that was about 5.5%. So it calculates the ROIV ratio for the start period and all these possible end periods. And then it calculates the mean and the standard deviation, and that is what the plot shows for each time step. So here in 2007, the average ROIV ratio was about 9%, but for the large share buyback in 2014, it was about 0%, and in 2017, it was minus 1.3% on average. And that is because the present value of the subsequent dividends and share prices were a bit less than the share price at this point in time, so the share buyback was a small loss. This might change if in the next year or 2, for example, the share price regains, let's say, 50 or 100%. Then all of this data is recalculated and the plot is made again, and this could potentially show a gain. or if the share price declines even further, then these numbers would be recalculated and they would show a greater loss. So as they say, it ain't over until the fat lady sings. Meaning, whether a share buyback is a gain or loss depends on the subsequent dividends and share prices, so that can still change until we are far enough into the future that the present value no longer matters that much. And the bottom plot shows the return on buyback ratio, which is also the gain or loss caused by the share buyback, but now it is relative to the amount used on the share buyback. The buybacks it made in 2006, 7, and 8 had gigantic return on buybacks. So this one is over 300%. Let's look at another example, and this is the Harley Davidson motorcycle company from the United States. And again, we click on the returns tab and share buyback. And the top plot shows us that the price to sales ratio has more or less declined for the whole period from a peak around 5, and now it's down around 0.6. Let's also take a look at the share price. So this has fluctuated up and down, up and down, up and down, and now it's way down. And let's look at the financials and the sales, and these have also fluctuated. And let's look at the share counts. So these have decreased gradually over time because of the share buybacks. Let's go back to the share buyback valuation here. Another thing to note here is that they basically made share buybacks most of the time, except for 2 periods, here from 2008 until 2011. And this was the period of the great financial crisis. And that is also when their stock was the cheapest. And then again from 2020 until 21. And that was a time of the COVID pandemic where again the stock was cheap. So this company has done the opposite of what they should do. And because the stock price has more or less fluctuated and gone sideways and trending downwards, pretty much all of its share buybacks have resulted in a loss to the remaining shareholders, as we can see from the return on intrinsic value. The return on buyback has some strange zigzagging tendencies here, and that is because the database we are using here only has the net buyback amount, and sometimes the company doesn't make a share buyback in a quarter, but it issues stock, for example, for employee stock options, and then you see this zigzagging pattern here. Let's look at another example, and this is for AutoZone, which is a large retailer for auto parts. Let's click on returns and share buyback. And here the price to sales ratio has gradually gone up over the past 30 years. And if we go up here and click on margins, we can see that the profit margins have gradually increased during this period. So that is probably a part of the explanation why the price to sales ratio has gradually gone up as well. Let's look at the financials. So the sales have grown a lot, and we have the growth rate over here. This is the compounded annual growth rate looking backwards. So from the most recent data point to here, to here, to here, to here, to here, to here, to here. And for the past 30 years, the sales has grown about 6-7% per year on average. Let's also take a look at the number of shares. And that has decreased from something like 152 million down to around 17 million over those 30 years. And let's look at the share price. And that has gone from 30 up to 3,400 now. So let's look at the share buyback returns again. And the second plot shows us that the company has just bought back shares every quarter basically, with very few exceptions. Because of the 6-7% compounded annual growth rate, the increase in profit margins, and the tremendous increase in share price, all of these share buybacks have basically resulted in gains for the remaining shareholders. And the return on buyback ratio shows that relative to the amount of the buyback, these are tremendous gains. Notice that the ROIV and ROB ratios taper towards 0 in the most recent data points. That is because there's not much subsequent dividend and share price data available, and the share prices are probably roughly the same. So it is too early to determine whether the recent share buybacks in the last few years were a gain or a loss to the remaining shareholders. We have to wait, let's say, 5 or maybe even 10 years before the data is in, so we can pass judgment on whether those share buybacks actually caused a gain or loss for the remaining shareholders. Let's look at another example, and this is the Western Union Company. And for the last 20 or 30 years, they have mostly been doing money transfers worldwide. So we click on returns and share buyback. And the top plot shows that the price to sales ratio has gradually declined over the last 20 years or so. But like the previous company, this company has also just done share buybacks more or less all the time. But the company has been declining. Let's take a look at the sales. So flattish for some years and then starting to decline. And the shares have decreased over this 20-year period because of the buybacks. The share price has fluctuated up and down, and in the last few years, it has declined significantly. The profit margins have mostly remained between 15 and 20%, except for a temporary drop here for a few years. Let's go back to the share buyback valuation. So because the present value of the subsequent dividends and share prices actually turned out to be lower because the company was overall on a declining trend, it means that pretty much all of the share buybacks have caused losses for the remaining shareholders, and they would have been much better off with dividend payouts. Now imagine that we take these bottom two plots for all stocks in America, and we combine them into a single plot. That has actually already been done in the paper, and it's for about 2,600 of the largest American stocks for the last 30 years or so. So this represents most of the American stock market. So these two plots basically combine these two plots here for one company, and these two plots here for another company, and these two plots here for a third company, and these two plots here for a fourth company, and so on for about 2,600 companies. And then they have been clipped at ±5 interquartile range because some of the values are very extreme. But overall, this shows us that about half of the historical share buybacks for the past 30 years in the United States have been losses and half have been gains. These two plots here are a hydrogen bomb on the academic theory that share buybacks and dividends are equivalent. Because these two plots show that in reality, half of the buybacks have resulted in losses. That many trillions of dollars have been wasted on buybacks in the United States. And finance professors still, to this day, claim that buybacks and dividends are basically the same except for taxes. They are effing morons. Okay, I was spitting so much when I said this, and now there's spit all over my screen. Now imagine that you are a CFO and you have to decide whether to make a share buyback or a dividend payout today. You do that by estimating the future earnings that could be paid out as a dividend, and you can also estimate or forecast the future share prices, and then you plug those into the valuation formulas that we derived a moment ago. The problem is that the future is uncertain, so you have to do these calculations with many different values. And even if you use a spreadsheet, this may be complicated and takes a long time. So that was the exact problem that this simsim.run website was built to solve. It can do a lot more now, but originally it was built to value share buybacks. So we click on models, and then we type buyback, and then we have 4 different simulation models for valuing share buybacks. The first one is where you input a probability distribution for the intrinsic values directly, and we won't use that one here. Instead, we will use this one here, which uses terminal growth. So I hold Control and click the link, so it opens a new tab. And let's try and use the Sturm company again as an example. So it populates as many fields as it can with the most recent data for this particular stock. Some of this is not valid. For example, the buyback amount and the excess cash is not data that it can grab easily from the financial statements, so we have to fill that in ourselves. If there is a gray data button, you can click on that to see some data that is relevant to the field. And here we can see that this company has $105 million in cash and equivalents and short-term investments. And let's click on liabilities. And we can see that most of that is equity, and it doesn't have any current or long-term debt whatsoever. So most of this cash is probably in excess of what the company needs. But we will see in a moment that this company has very volatile and unpredictable sales. So that's why they want their balance sheet to be an absolute fortress. Let's say in this example that $80 million is in excess. So we type that in here, And we can say, let's say that we just want to use $50 million of those for a buyback. Now let's click on the earnings, and these are probability distributions. And if we click on the data button, we can see the historical data for the company. And the gray selection here is what is being used for the probability distribution. So let's select the data all the way from 2010 until now, and then click this button here, and then select net income. Because there are only a fairly small number of discrete data points, we get discrete data points here as well. So let's click data again. And if I hold down Control while I click this button, then it transforms those data points into a smooth distribution. Now I actually like to do this in a different way. So I hold down Control and click the stock symbol here. So a new tab opens with all of the stock data. This has been given an AI score of -2, and the score could go from -10 to +10, and it has a below average score because the AI robot thinks that this is a highly unpredictable company. So even though it has a fortress of a balance sheet, the future is very unpredictable for this company. Let's take a look at the financials here and the sales, and you can see how the sales fluctuate. So if I were to value this as an outsider, and probably even as an insider, because I don't think the CFO has much better insight than we do as outsiders for what is going to happen in 5 or 10 years with this company. So instead of just selecting the last year or so for the sales, I would select something like this. So for the last 12, 13 years or something like that. So we get all of these sales fluctuations. And then we go up to the margins. And then I would also select for a longer period that I think might be representative for the future, let's say 5 or 10 years. We can also select a valuation ratio. So here is the price to sales ratio, and the dashed line here tells us what the current price to sales ratio is, so we can quickly see where we are now relative to the history. Then we can click on the sim button, and it performs a few simple simulations using the data that we have selected here. So this is the earnings yield, and it is simulated from the net profit margin and the sales that we have just selected. And those values are all multiplied together to simulate the earnings, which we also have here. And then for the earnings yield, it divides the simulated earnings with the most recent market cap. And for the price change, it uses the selected price to sales ratio and the selected sales data to simulate the future share price. And then it is divided by the current share price. And these two are actually all I use for most of my valuations when I want to quickly assess whether I think a stock is cheap or expensive. And this simulated earnings here is much better than just selecting the earnings for the last 5 or 10 years or 2 years or whatever you want. So we click on this button here to copy the distribution into the clipboard. We could also select just a part of it, for example like this, and click the button. But in this case, I want to use all of it. So I click the button here. I go back to my simulation for the share buyback here. And for the first year's earnings, I right click on the tab and I click paste. So now we have this simulated earnings here. Let's look at year 2 and 3 and 4. And these are all the same as the previous. So these are all using the same probability distribution. Then we have the terminal growth rate, and that takes the last earnings distribution and assumes it will grow by this rate for all eternity. And we can also make this as a probability distribution, for example, a normal distribution or uniform or our own custom distribution, which we can also make smooth like this and do it again and again. Let's set it back to the constant of 0. To model this properly, we really should take into account that the growth is not free. So we really should deduct the money that is needed, for example, for capital expenditures or for acquisitions or whatever it might be from the earnings distribution. And it would be nice if that was built into the simulation model so it does it automatically. But I haven't quite decided how to do that yet. So currently, if you want growth, either you would have to subtract the amount from the earnings yourself, and you can do it by tweaking it in here and adding or subtracting up here. Or you will just have to keep in mind that the future earnings are overestimated because you haven't subtracted the money that is needed to fund the future growth. But in this example, we'll just keep the growth rate at 0. So let's go to the discount rate that is used to calculate the present value. And you might argue that because this company has such a fortress of a balance sheet, they have a lot of excess cash, the discount rate could be a lot lower. So let's make it like this. And you could also make it constant or uniform or some other distribution. So now we are ready to run the simulation, and we click the blue button here and we get the results here. So this plot shows the return on intrinsic value. So how much the per share intrinsic value would change from this share buyback. We can see it has a probability of loss of 24%, and the peak is around 2.5% or something like that. So let's look at the plot for the return on buyback. So this is again the gain or loss, but now measured relative to the buyback amount. And in this simple example, it looks like the earnings distribution. And notice one thing, that the probability of loss is 28% here, but it was 24% here. And that is because the outliers are clipped before the probability of loss is calculated. So let's go up here and click on Sim Vary. And on the x-axis, it varies the current share price. So it takes the current share price that we have entered here, and it makes that in the middle. And then the plot shows what the ROI ratio would be if the current share price was actually something else instead. Let's try and clip these outliers a bit more. So we click here and settings and various, and we have to move the slider to the left to clip more outliers. Let's try it again. So we can see if the share price was, for example, $30, then the peak of the distribution, which is shown as darker blue colors, would be around 5%. Let's try and click on the ROB tab here. And here we can see that, for example, at $50, there will probably be a 50-50 chance of a loss or a gain as a result of the share buyback. But notice something if we go back to the ROI ratio, and for $50, it's different. And that is because the ROI ratio has a non-linear formula where the losses are much bigger than the gains. One of the advantages of the ROB ratio is that it can be compared to other investments that the company could make by comparing the ROB ratio to the net present value ratio of the alternative investment. And let's try and do that. So we go back to the models and we click here and write dist, and we take this one here, distribution comparison for percentages. Let's say we have an alternative investment and the net present value of that is 50% on average with a standard deviation of, let's say, 10%. So we have this distribution for the alternative investment, and we write it here. And then we want to compare it to the ROB ratio of the share buyback. So we go back over here and let's make for a share price of $40, and we click Sim. And then we take all of this distribution and copy it to the clipboard, and we go back to the comparison and we click on distribution 2 and we paste it, and we type in ROB share price $40. And I have done the same for the other distribution. 3 has a share price of 30, and number 4 has a share price of 20, and the last one we disabled. Let's try and run this simulation, and we get this plot here, and these are spread out really far. So let's try and clip some of these between, let's say, -100 and +300. So we go into tweak here and we say -100% and +300%, and we do that for the others as well. In this simple example, even when the share price is very low, it is possible that the buyback would result in losses. But right now, the share price is almost $40, and in this case, it would probably be more profitable to make the alternative investment instead of the buyback. Now let's go back to the simulation, and I want to reuse as much of this data as possible in a new simulation. So I go up here and click More and Copy. And then I go to the models and I type in buyback. And now I want to also simulate the future share prices. And I prefer to do this using the price to sales ratio. So I hold Control and click the mouse on this link here. And I just have to enter the stock symbol again. And if we just look at the earnings here, you will see it is not the distribution that I want. Let's try and click More and paste. And now we get all of the data from the previous simulation. Let's just go back to const here and see how everything is correct. But the current share price is only 10, and I want it to be the latest one. And there's a little trick to get that number back. You can see it here if you hover over the information icon. It was 38.94, but there's a little trick. If we double click this one here, we get it back. And the other fields are the same as before, so that's good. Then let's click on sales, and this is the same distribution as before, but it is using discrete values. So let's click on the data button. You can see it is the same selection, and we can hold Control and click this button here. So we get it. Alternatively, we can also click more and click smooth, and we get the exact same smooth distribution. And we click on price to sales ratio. And that is already smooth because that distribution has so many data points that the system automatically makes it smooth. We also have a scale, and that is only multiplied with the price to sales ratio in the buyback scenario and not without the buyback. And you can use that to model a change in sentiment. If you think that the investors will like the buybacks, you can make this higher than 1. Or if you think that they will punish you because they don't like the buybacks, then you could make it lower, let's say 0.8. Or you can just leave it at 1 so that the price to sales ratio is the exact same with or without a buyback. And again, we have the discount rate, and that is the same as the other simulation. And now we have the tax rates for the dividends and the capital gains, but let's leave these at 0 to begin with. And we click the sim button. This is a so-called violin plot, which shows the probability distributions for each of the future years. So for a shareholder who owns the stocks for 1 year, and another shareholder who owns the stocks for 2 years, and another one who owns it for 3 years, and 4 years, and 5 years, and so on. And if we click on the ROB tab here, we get the return on buyback ratio instead. And if we click on the SimVary tab, all 10 future years are combined into one plot, where the current share price is again varied on the x-axis. So here we have the ROI ratio and the ROB ratio. And we can also click on the Dist1 tab so that we can see an overview of all of the input distributions. And for the price to sales ratio, the dashed line shows what the current price to sales ratio is based on the current share price that we have input. Not what it necessarily is today, but what we have input over here on the const tab here. And because we're using the same distribution for the price to sales ratio for all 10 years, all of these are the same. But we can see that the current price to sales ratio is in the lower end of this distribution. Then we would get a gain in the share price just from revaluing the price to sales ratio up again. And if we click on the Dist2 tab, then we have the other input distributions. And we were using 0 tax rates for the dividends and capital gains. But one of the main arguments in favor of making buybacks over dividends is that there is a tax advantage. So let's try and input some tax rates here. Let's just save this simulation first, and then let's load an exact copy in another tab. And then in this second one, let's make some tax rates here for the dividends. Let's say it's 30%. And for the capital gains, it's only 10%. And then let's click sim, and we get the ROI ratios here. And then let's go back to the simulation where there are no tax rates, and we get these ROI ratios here. And let's compare the two. So this is without any taxes, and this is with dividend taxes that are much greater than the capital gains taxes. So without taxes, with taxes, without, with. So you can see that the taxes do matter, but these are just 2 factors. And what really matters whether the buyback is better than a dividend is the overall mispricing of the stock. So is the current share price greater or less than the intrinsic value when the intrinsic value is calculated from the future earnings and the future share prices? So I would like to show you a few more examples for other stocks, one that seems to be severely overpriced and one that seems to be underpriced. So let's go back to models here and control click this one here. And let's look at Walmart. So we click data here, which shows the dividend and net share buyback amounts for the trailing 12 months. And we can see that these are often 5, 8, 9, 10. So let's just say $6 billion that we will use as a buyback. And we can click on the data button here so we can see the assets and liabilities. And they do have almost $11 billion in cash and equivalents. So let's just say $6 billion in excess cash. That is fine. They don't do the buyback all in one day, so they generate cash from operations and then spend on buybacks and so forth. Okay, so let's click on earnings, and if we click on data, this has just been copied from the historical earnings from the last few years. And let's do it the same way as before, where we simulate the earnings from the net profit margin and the recent sales. So I control click on the symbol here, and I go to that tab. I click on financials, we select the last sales, and then we click on the margins tab. And let's use the data from 2015, and we click sim, and we click earnings, and we click here to copy it to the clipboard, and we go back to the buyback simulation. We right click on year 1 and we click paste, and all of the other years are just using the same distribution. So let's click on the sales tab, and this already have the most recent data. And then let's click on the price to sales ratio. And if we click on the data button here, you can see that the price to sales ratio has increased dramatically in just the last few years. And it has already initialized the distribution with the data from 2015 until now. Otherwise, we would select it and we would click here. And the scale on the price to sales ratio, we leave it at 1. And the discount rate, let's lower it to an average of 8% with a 0.5% standard deviation. And the tax rates, let's leave those at 0 in this quick example. So we click the sim button and we get the results here. So the return on intrinsic value is pretty much 100% loss. And let's look at the ROB ratio, which is the gain or loss relative to the buyback amount. So we can see those distributions are between -40% and more than -70%. And if we click on the Dist1 tab, where we see that the historical price to sales ratio was much lower than the current price to sales ratio. So we expect that the stock will be revalued downwards. Let's look at another example. So we go back to the models and we control click this link again. And then we type in the symbol for the company PayPal. And let's just click at the data button for the buyback amount. And they are spending almost $6 billion on buybacks. So let's do that. And let's click on the data button for the assets and liabilities. And they have $18 billion in cash and equivalents and short-term investments. And let's look at the liabilities where they only have a little long-term debt. So it looks like they definitely have $6 billion in excess cash. And again, the earnings, and I want to simulate that from the net profit margin and the sales as we did before. So I hold control and click PayPal symbol, and I go to the financials and the sales, and we select the most recent, and we go to the margins tab, and we are using all of the data from the last 11 years or so. And let's just click on the valuation tab as well, where the dashed line shows us that this is a historically low price to sales ratio. And the selection is for the last 4 years or so. So we click on the sim button. And if we click on the price change, we see that most of these are gains, where the peak is around 75%. And that is because the historical price to sales ratio was much higher than it is now. So let's click on the earnings tab. And let's click plus to get this on the clipboard. We go back to our share buyback simulation. We right click on this tab here. We click paste. And then we get the simulated earnings distribution here. We click on the sales tab, we click on the data, and we are already using the most recent. And then we click on the price to sales ratio, click on the data here. And again, we are already using the same selection as before. And we leave the scale on the price to sales ratio as 1, and we go to the discount rate. And let's just keep this at the distribution we have here, so 10%. So this is a bit higher than it was for the other 2 examples. So this results in a lower and more conservative present value. So we click the sim button and we get this data here. And we see that the return on intrinsic value is typically between 6 and 12% for the first year. And it gradually declines. And for the 10th year, most of the distribution is between 4 and 9%. Notice that they are gradually drifting downwards over time. And that is because all of the input distributions for the sales, earnings, and price to sales ratios remain the same. 1 more year of earnings is not enough to make up for 1 more year of discounting by 10% on average. We can try a higher discount rate. So let's make it, let's say 15%. and then the drift is even more pronounced. But let's just set the discount rate back to 10% on average again, and then click Sim again. And let's look at the ROB ratio. And the bulk of the distribution is between, let's say, 60 and maybe, let's say, 180%. And that drifts downwards as well. Let's click on the Sim Vary tab, which combines all of the 10 years in one plot. So for the current share price around $45, and if these input assumptions are reasonable for the future sales, earnings, and price to sales distributions, then a buyback today for $6 billion would increase the per share intrinsic value about 7% on average, with practically no probability of loss. And let's look at the ROB ratio, which compares the change in per share intrinsic value to the buyback amount, as if it was just the net present value ratio of some investment that the company was making. And the dark blue color shows that the most likely outcomes would be between, let's say, 50% and 100%, or maybe even 150%. So if these assumptions about the future are reasonable, then this would be a fantastic buyback at the current share price. So that is really all there is to it. The system is easy to learn, and once you're used to it, you can literally make a buyback simulation in less than a minute. So in the future, this can help you avoid making share buybacks that cause a loss for the remaining shareholders. Good luck!